Welcome to The Deep Dive, where we cut through the noise of earnings calls to bring you the insights that really matter for experienced investors. Today, we're dissecting BioLargo's second quarter 2025 earnings results. And this is, well, it's a classic tale of transition, really. You've got a legacy product facing some headwinds.
Right.
While these ambitious new ventures, they hint at a potentially, transformational future. So we'll break down the numbers, explore management's strategic pivot, and look at the broader market context for what might be next. Okay, so BioLargo's Q2. It certainly got a cautious reaction from the market. The company reported a GAAP EPS of negative 0.3004, that's earnings per share.
Yeah, not great on the surface.
And revenue came in at $2.777 million. Now, this figure significantly missed the third-party forecasts. They were looking for around $4.0 million.
Did miss.
Yeah, and it represents a substantial year-over-year decline, 44.6% from Q2 2024.
But what's interesting is that despite this overall revenue contraction, if you look at the balance sheet, right, as of June 30th, 2025, BioLargo still had $3.47 million in cash. Total assets were at $12.49 million, and stockholders' equity at $6.06 million. So some runway there.
Okay.
But the true bright spot was their engineering segment. It showed explosive growth. I mean, surging 517% year over year.
Wow, 517%.
Yeah. This was largely driven by crucial air quality compliance work. And that contributed to a first half revenue of $6.04 million and importantly helped stabilize the overall gross margins. So that segment is clearly, already bearing fruit.
That significant revenue miss, though, that was primarily attributed to a slowdown in sales of their private label pet odor product. You probably know it as Pooph.
Ah, yes, Pooph.
Management characterized this more as a mix shift within their business rather than a fundamental competitiveness issue.
Okay, that's their framing.
Right. They also pointed out that effective cost management helped them maintain or even improve gross margins during this, challenging period for top-line revenue. So the numbers, they tell one story, right? Decline in some areas. But management clearly believes there's let's say, a powerful narrative unfolding just beneath the surface. Let's really dig into the strategic initiatives they're betting their future on. What were the key areas they emphasized for forward guidance?
Yeah, management gave some directional commentary, and they focused on three core areas. First, they expect continued momentum in that engineering segment we just talked about. That's been a clear success story, no doubt.
Makes sense.
Second, they're looking for a significant ramp up in Clyra Medical's distribution.
Okay.
And third, the focus is squarely on commercialization partnerships for their Cellinity battery technology, which, raises a really important question for investors. Can these strategic plays truly offset the recent revenue headwinds from Pooph?
Let's delve into those strategic initiatives then, starting with Clyra Medical. The company has aggressively expanded its distribution network. I mean, we're talking about reaching approximately 6,100 hospitals.
Rounding numbers.
6,300 ambulatory surgical centers, or ASCs, and 2,200 wound care clinics across the U.S. This broad reach is, it's absolutely crucial for getting their infection control products out there.
You need a network first, yeah.
Management expressed really high confidence, even describing Clyra as a game changer, potential to transform the industry. Now they've invested just under $20 million over 13 years into this venture.
A long time.
13 years, yeah. With substantial efforts just in the last, say, 12 to 18 months to really prep it for a major launch. They're hoping for a Q1 launch after completing third-party testing and the FDA filing by year-end. And this is supported by a recent $3.3 million investment from private investors who, interestingly, had access to non-public details. So management sounds incredibly bullish here, but is the market right to be a bit skeptical until they see actual revenue ramp up, especially after such a long development period?
Well, that's a critical point, isn't it? While the investment timeline and that game changer rhetoric might raise some eyebrows, the fact that private investors with access to non-public details put in $3.3 million at this specific stage, that is a tangible vote of confidence.
Good point.
The market often wants to see, the tangible purchase orders, the sell-through metrics. That's understandable. But that private investment suggests some, let's say, sophisticated parties see the potential for a Q1 launch to be quite impactful. The challenge, as always, is converting that distribution access into actual, recurring revenue.
Absolutely. Okay, now shifting gears to the Cellinity battery technology. This is where things get really intriguing. It received independent validation from US BESS Corporation back in June. That's a significant technical milestone.
Validation is key.
Definitely. And the company has already signed 4 Memoranda of Understanding, MOUs, for potential factory joint ventures. Their business model here is quite unique. Instead of building battery factories themselves, they aim to be a, quote, vendor to the venture.
The capital light approach.
Exactly. It means they sell the blueprint for factories, provide engineering, design, training, and in return, they get revenue, royalties, and equity. A truly capital-light scaling strategy. They stated they've invested only around $2.5 million into this, what they call breakthrough technology.
Only $2.5 million.
Yeah, a dramatically lower figure compared to typical industry R&D, which they put at maybe $25–50 million for similar advancements. So only $2.5 million invested. Does that sound almost too good to be true? Or is there genuinely a disruptive innovation here that just defies typical costs?
That's, I think, precisely the core insight here for you, the investor. The claim of a breakthrough battery for $2.5 million versus an industry norm of, say, $25–50 million.
Yeah.
That's a staggering differentiator.
It really is.
The question isn't just if it's disruptive, but whether this capital light approach is a genuine strategic advantage that lets them scale effectively.
Oh.
Or, if it perhaps signals a lack of the necessary, let's call it burn rate, to rapidly compete in such a capital-intensive sector.
Right, double-edged sword, potentially.
If it's real, it's a huge competitive edge. If not, well, it raises concerns about their ability to meet future demand down the line.
That's a sharp distinction. And if we connect this to the broader context, this Cellinity battery technology is designed specifically for long-duration storage.
Yeah.
Grid-scale applications.
The big stuff.
Exactly. Think of balancing grids, offloading renewables, providing emergency backup for critical infrastructure. Data centers are a huge one right now. Industry forecasts, like from The Economist, predict this market could grow to a staggering $3–4 trillion over the next 15 years.
Trillion with a T. That's a massive addressable market.
Mm-hmm.
And the Cellinity battery itself boasts some pretty impressive features that seem to position it well for that market. High energy density, 95% round-trip efficiency, low cost of goods, recyclable components.
All good things.
No rare earth elements, and crucially, no China supply chain dependence.
That last one is huge right now.
Absolutely. It addresses key vulnerabilities and, frankly, demand drivers around national security and supply chain stability. And as you mentioned, their vendor-to-the-venture model means they provide the engineering services, project management, design, training. They project each factory could generate maybe $500 million annually.
$500 million per factory.
That's the projection. With over 16% net income after debt service and royalty, that equates to maybe $75–90 million for the JV partners and for BioLargo. They get revenue, royalties, and a minority equity stake without directly funding the actual factory construction.
That makes their capital-light approach incredibly interesting, doesn't it? However, the company does acknowledge significant barriers. Scaling manufacturing, achieving full technical proof of claim at commercial scale.
The usual hurdles for hardware tech.
Right. They view this primarily as an engineering task.
Mm-hmm.
They also plan to leverage public funding and tax credits, drawing a comparison to how Tesla scaled its operations.
The supercharger network parallel, maybe?
Sort of, though they emphasize Tesla focused on EV charging stations, leaving, in their view, a critical gap in long-duration storage that they aim to fill, but is relying heavily on public funding, a truly viable path for such a capital-intensive scale-up.
Look, it absolutely can be, particularly for technologies aligned with national energy security, climate goals,
Yeah.
The big policy drivers. We've seen significant government incentives for domestic manufacturing, renewable energy infrastructure. It happens.
Sure.
The risk, of course, is always timing and bureaucracy. But it's a well-trodden path for these kinds of capital-intensive ventures. The real test, I think, is the execution risk. Can they actually translate these MOUs and plans into real revenue-generating factories? That's the question.
Speaking of other commercialization efforts, let's quickly touch on PFAS and water solutions. Commercialization is ongoing there. They initiated alpha testing of a portable PFAS test kit on July 1st.
Timely, given the regulations.
Very timely. That's a key step given the rising regulatory pressure around these forever chemicals. The Advanced Oxidation System unit for their New Jersey project was recently shipped, awaiting setup. And significantly, both the state and federal EPA are set to participate in validation work for this system.
Getting EPA buy-in is huge.
Absolutely. That kind of official validation is a massive step for market adoption, especially with increasing EPA rules on PFAS in drinking water.
You know, throughout the call, management continuously stressed this concept of unseen value, arguing that the company's current market valuation just doesn't fully reflect the potential of its innovative technologies and ventures.
We hear that a lot from tech companies.
We do. And the key insight here for investors, I think, is often less about the technology's inherent potential and more about the market's demand for demonstrable traction.
Yeah.
Whether that's purchase orders, definitive JV agreements, clearer profitability timelines.
Right.
You know, something concrete.
Right. The unseen needs to become seen.
Exactly. The unseen often remains invisible until those concrete milestones are actually hit. Their strategy of forming subsidiaries, licensing tech to them, it aims to conserve capital at the parent company level. We see that clearly in the Cellinity battery strategy, where the JVs are intended to self-finance.
And on the leadership front, something interesting. The CEO was appointed chairman of a subcommittee enabling innovative technology for the U.S. Department of Commerce Environmental Technologies Trade Advisory Committee. That's a mouthful.
It is, but potentially very valuable.
You think so? What's the direct, tangible impact of a role like that on BioLargo's bottom line? Or is it more of a long-term, reputational play?
I'd say it's primarily a long-term reputational and strategic play. It gives them a seat at the table where policy and trade initiatives are shaped. While it doesn't directly add, say, dollars to revenue in the immediate short term, it provides a unique opportunity for influence over policy that promotes trade, drives adoption of cutting-edge environmental tech, which aligns perfectly with BioLargo's whole mission. It could certainly open doors to future opportunities down the road.
Now, circling back quickly to the Pooph product, management acknowledged its slowdown caused a significant revenue hit.
Could really ignore that.
No. While they remain optimistic about its future and their partners' marketing, they also noted the financial burden of providing financing for this partner and the uncertainty that creates for forecasting. So it's a kind of a tricky balance for them there.
Adds another layer of risk.
It does. And just for context, their team size. The company currently has 41 full-time employees, including Clyra and Canadian operations. And Clyra's headcount specifically increased from just 3 to 10 this year, clearly indicates where the focus is shifting.
Put in resources behind Clyra, yeah.
Okay, so after all that, what does this all mean for you, the investor, looking at this? The market's immediate reaction to the earnings was, well, notably cautious. Shares experienced a sharp drop midday, closed down almost 4% on the call day. Trading volume was slightly above average, but nothing crazy.
And if you look at performance over time, the stock has significantly underperformed the small cap benchmark. Last month, 3 months, the full year.
Ouch.
Yeah. This divergence really highlights a clear gap, doesn't it? On one hand, management emphasizes the long-term valuation gap, this robust pipeline. On the other, the market seems laser-focused on the immediate revenue miss and that slowdown in the Pooph product line.
Short-term versus long-term view.
Exactly. Investors are clearly seeking clearer timelines, measurable financial impact from the commercialization efforts of Clyra and Cellinity. They want proof points.
The industry backdrop, however, that remains quite favorable, wouldn't you say? Heightened PFAS regulatory activity is driving demand for water treatment solutions. That's undeniable.
Absolutely.
And grid-scale energy storage is a really active investment theme for utilities, critical infrastructure, driven largely by that insatiable demand from data centers and AI. So BioLargo is certainly positioned in the right markets for the long term.
Right. So key catalysts for investors to watch closely. Definitely initial purchase orders and sell-through metrics from those new Clyra distributors. That's number one.
Got to see the sales.
Got to see the sales. Also, formal JV terms or capital expenditure commitments for Cellinity, any milestones for the PFAS, test kit validation, EPA or state validation updates. Additional engineering contract awards would be good too. And crucially, the Q3 earnings print. Need to see sequential revenue and gross margin traction across the portfolio. That will be a critical signal because at the end of the day, the execution risk translating promising tech and distribution deals into actual recurring revenue that remains paramount.
All right, let's move to our not financial advice segment. Given BioLargo's, let's say, mixed Q2 and its bold long-term vision, How might an investor approach this situation? Let's explore a couple of speculative ideas for those looking at potential dislocations here.
Okay, sure. So given management's persistent emphasis on that unseen value and the current disconnect between their optimistic long view and the market's cautious short-term reaction, a long straddle could be an interesting, albeit risky, play.
Explain that.
Well, this trade essentially bets on a significant price movement, but you don't care which direction, up or down. It's potentially ideal for these high-conviction, high-risk situations where a major catalyst could send the stock either soaring or, frankly, plummeting.
Okay, how does it work?
You'd buy both an out-of-the-money call option and an out-of-the-money put option with the same expiry date, maybe 6-9 months out. The thinking is, if any of their big initiatives, like a definitive Cellinity factory JV contract, or maybe substantial Clyra purchase orders, if any of those hit a major positive catalyst, the stock could see a dramatic upward re-rating, making the call valuable. Conversely, if revenue challenges persist, partnerships fail. There could be significant downside, making the put valuable.
So you're betting on volatility itself.
Precisely. You're essentially saying, look, the market is fundamentally mispricing this story, but I don't know which way it's mispriced or when it will correct. But I think it will correct violently.
Interesting. Okay, what about something a bit more nuanced? Maybe a relative value play. Consider a Pooph pivot, short strangle with a long engineering hedge.
Okay, break that down. A short strangle.
Right.
The decline in the Pooph sales clearly hit the revenue headline. The company's actively trying to de-emphasize it. So you could initiate a short strangle that means selling an out-of-the-money call and selling an out-of-the-money put. You're effectively betting on the stock staying within a tighter range, assuming the Pooph decline is maybe already priced in, and those major catalysts are still some ways off. You collect the premium.
Okay, but that's risky if a catalyst does hit and sends the stock soaring, right? Your short call gets blown out.
Exactly, which is why you add the hedge.
So to mitigate that risk, you'd simultaneously consider maybe a long position in a more stable, smaller cap engineering services firm. Or maybe an ETF focused on environmental compliance solutions. Perhaps even one with a strong presence in air quality, the segment that's actually working for BioLargo right now.
This acts as a kind of conceptual hedge. It gives you exposure to the very market trend driving their successful segment currently. It diversifies away from the idiosyncratic risks of their specific product commercialization efforts, Clyra, Cellinity. It's essentially a bet that the market's overall sentiment on engineering services is positive, which could indirectly support BioLargo even if its other lines struggle, or at least provide a sort of counter-cyclical investment within the theme.
Got it. Now remember, everyone, these are highly speculative ideas. They're for sophisticated investors only, and certainly not recommendations.
Absolutely not. Always conduct your own thorough due diligence.
And consult with a financial advisor, please. Okay, so to recap this deep dive, BioLargo's Q2 was clearly marked by that significant revenue miss, largely due to the decline in the pet odor product line, Pooph. That was a central concern for the market, no doubt.
Yep, clear focus.
However, we definitely encourage you to delve into the company's filings, public statements, get a deeper understanding for yourself. And we value your insights, so please share your thoughts on this deep dive and what you're watching next for BioLargo.
And the standard disclaimer, this is not financial advice. All investments carry risk, and past performance is absolutely not indicative of future results.